The American housing market isn't cooling, it's quietly imploding in real time, and almost no one is prepared for what the data now shows. Total household debt in the United States has exploded to an all-time high of $18,590 billion, according to the latest New York Fed report. And the largest piece of that burden? Mortgages now sitting at $13,070 billion after jumping another $137 billion in a single quarter. That isn't stability, that's acceleration. The average family earning $78,000 can now afford less than 18% of homes nationwide. Rising prices didn't make Americans wealthier, they made Americans leveraged. Inflation wiped out real gains, and cheap credit disguised it as prosperity. What looked like home equity was nothing more than borrowed time. The system hasn't just weakened, it's cracking underneath record debt levels. This is the beginning of a structural failure, silent, slow, and unavoidable. The collapse didn't begin with foreclosures or falling prices. It began the moment mortgage rates detonated the financial equation holding the market together. In 2021, Americans were locking in 30-year mortgages at 2.6%, the cheapest money in modern history. By 2025, that same loan carries a rate near 7.8%, a tripling of borrowing costs in less than 4 years. The math is devastating. A $400,000 mortgage that once cost about $1,600 a month now demands nearly $2,900, an $1,300 increase for the same house, with no added value, no added income, no added anything. Buyers didn't slow down, they disappeared. Millions who were qualified in 2021 aren't even close in 2025. And sellers, trapped in nostalgia for the era of free money, are still clinging to delusional asking prices. The result isn't a market pause, it's a complete seizure. The housing engine didn't stall. It choked to death on interest. But the real fracture in housing goes deeper than rates. It's the widening chasm between what homes cost and what Americans actually earn. Over the past 4 years, the median household income crawled from $70,800 to $78,000, barely a 10% increase. Meanwhile, the median home price blasted from $329,000 to over $420,000. That is a catastrophic mismatch, a 10% rise in income versus a 27% surge in home prices. You don't need an economist to see the problem. You need a calculator and a pulse. The average worker now needs 45% of their gross income just to service a mortgage, the highest burden ever recorded in U.S. history. At that level, the system doesn't bend, it breaks. Credit quality weakens. Banks pull back. Loan approvals collapse. And even the buyers who barely qualify face monthly payments that swallow every spare dollar. Housing didn't become unaffordable. It became mathematically impossible. For nearly 2 decades, the housing market wasn't driven by real demand, it was driven by artificial demand created by ultra-cheap money. Zero-rate policies, pandemic stimulus, investor frenzy, and record-low mortgage costs pumped gasoline into a market that never should have been able to rise this fast. Prices weren't supported by wages or productivity, they were supported by debt. But now the credit engine that inflated the bubble has slammed into reverse. Every single percentage point increase in mortgage rates eliminates roughly 5 million qualified buyers from the market. That's the silent culling no headline talks about. Pending home sales are down double digits. Mortgage applications are hovering near 30-year lows. And the once invincible Sunbelt boomtowns, Florida, Texas, Arizona, are bleeding inventory faster than during the early stages of the 2008 crash. The demand that built this market wasn't organic, and now it's evaporating at the exact speed credit tightens. But the most dangerous pressure point in the entire housing market isn't individual buyers, it's the institutional giants who quietly turned American neighborhoods into financial products. By 2025, Wall Street-backed investors own nearly 1 in every 5 single-family homes, a level of concentration the market was never designed to absorb. These firms didn't buy homes with savings or cash flow. They bought them with borrowed money, credit lines, private loans, mortgage-backed facilities, synthetic rent-backed securities. It was the same playbook that inflated the 2008 mortgage bubble, just hidden behind new terminology and private credit vehicles. When interest rates exploded, these corporations didn't stop borrowing. They simply shifted debt into more opaque structures. But as yields rose, the value of those bonds fell. Suddenly, the spreadsheets that justified billions in acquisitions stopped working. And the leverage that made Wall Street unstoppable is now cracking under its own weight quietly but catastrophically. When leverage cracks, liquidation follows, and that's exactly what's happening behind the scenes. Institutional landlords, private equity funds, and REIT-backed mega investors are now unloading properties at 15% to 25% discounts. Not because they want to, but because they have to. These aren't value plays for buyers, they're survival moves. As interest costs reset higher, debt service on billion-dollar property portfolios has doubled. The math that once supported aggressive buying has flipped into a cash flow crisis. So the giants are quietly dumping homes to keep their balance sheets afloat, praying the public doesn't notice. But every fire sale becomes the new comp, and those falling comps immediately trap small investors who bought near the peak, wiping out their equity overnight. This isn't a correction, it's forced deleveraging on an industrial scale. And once it starts, it doesn't stop. It accelerates, crushing everything beneath it. The most dangerous part of any market collapse isn't falling prices. It's the moment liquidity disappears, and that's exactly where the U.S. housing market is right now. New home sales have fallen sharply, existing sales have cratered to multi-decade lows, and active listings have surged nearly 30% nationwide. Homes that once vanished in a weekend now sit untouched for 50 to 60 days, collecting dust and price cuts. But even the discounts aren't enough, because the buyer pool has been mathematically annihilated by high rates. Mortgage originations are down more than 50% from their 2021 peak, the steepest collapse ever recorded. Realtors, appraisers, inspectors, lenders, everyone tied to transaction volume is watching business evaporate. This isn't a slowdown. This is a frozen market where nothing moves unless it's distressed. Liquidity is the lifeblood of housing. And right now, that blood flow has stopped. Now the damage is bleeding into American households, and for the first time in modern history, families are defaulting on their homes before their cars. Early-stage mortgage delinquencies have surged 28% year over year, outpacing every other category of consumer credit. And it's not hard to see why. The average mortgage balance has climbed to $267,700, a record high, while the essential costs tied to owning a home have exploded. Property insurance is up more than 35% in many states. Energy bills have jumped over 20%. Property taxes are climbing everywhere. The median family now spends 43% of their net income just to keep a roof over their head. That leaves nothing, no buffer, no safety net, no room for a single unexpected expense. Savings rates have collapsed to historic lows, leaving millions one paycheck away from crisis. Households aren't stretched anymore. They're breaking. What's happening now isn't just financial stress, it's a full-blown debt spiral swallowing the middle class. With savings drained and wages lagging, millions of households are doing the unthinkable, using credit cards to subsidize their mortgage payments. Total household debt has surged past $18.6 trillion, the highest in U.S. history. Credit card balances alone just crossed $1.33 trillion. While delinquencies on auto loans, personal loans, and revolving credit are accelerating simultaneously. This is the exact pattern economists fear most multiple debt categories cracking at once. Americans aren't borrowing for luxuries anymore. They're borrowing to survive. Groceries, utilities, childcare, gas, all going on plastic at 25% interest. And as those balances snowball, lenders tighten standards even further, pushing more families out of the mortgage market entirely. This isn't resilience, it's deterioration disguised as normalcy. The middle class is now financing daily life with tomorrow's income, and tomorrow is already spent. Housing isn't just another sector of the economy, it's the engine that keeps everything else moving. And now that engine is misfiring on every cylinder. Residential construction spending has fallen sharply. Furniture orders have collapsed over 20%. Appliance sales are shrinking. And home improvement retailers, once unstoppable, are posting their first real contraction in a decade. The slowdown is spreading outward like a contagion. Construction job growth has plunged from 3% to barely 1%. Subcontractors are reporting cancellation levels not seen since 2009, and regional banks tied to real estate lending are quietly tightening the screws. When housing stops, thousands of supporting industries stop with it. Movers, contractors, landscapers, framers, electricians, inspectors, brokers, freight companies. Every stalled project freezes money that once circulated through local economies. This is the multiplier effect in reverse, a chain reaction where one slowdown cascades into another. Housing isn't cooling. It's pulling the entire economy down with it. The Federal Reserve didn't just influence this crisis, it engineered the conditions that made it unavoidable. Between 2020 and 2022, the Fed unleashed more than $6 trillion into the system and drove real interest rates below zero, igniting the biggest asset inflation in modern history. Housing wasn't booming, it was being artificially inflated by free money. Then, when inflation hit 40-year highs, the Fed slammed on the brakes with the fastest rate hike cycle since the 1980s, detonating the very bubble it created. Now the system is stuck in a mathematical contradiction. Cut rates and inflation reignites. Hold rates and defaults accelerate. Liquidity is evaporating everywhere. The M2 money supply has contracted at a pace not seen since the Great Depression. Regional banks loaded with property loans are tightening to survive. The Fed isn't guiding a soft landing. It's choosing between two forms of collapse, inflation, or insolvency. While everyday Americans cling to hope that the market will bounce back, the people who built this bubble are already heading for the exits. Hedge funds, private equity giants, and institutional landlords are liquidating assets at the fastest pace in more than a decade. Over the last 3 quarters, bulk property sales by major investors have surged over 60%, while new acquisitions have fallen to their lowest level since 2012. This isn't repositioning, it's evacuation. Regional banks exposed to real estate are slashing loan issuance by nearly 30%, and major lenders have quietly frozen new jumbo lending altogether. Behind the press releases about strong fundamentals are undisclosed mark-to-market losses and emergency capital calls. Even publicly traded home builders are flashing warnings as insiders dump shares. Capital is fleeing to treasuries, commodities, anywhere but housing. Smart money isn't predicting a collapse. Smart money is escaping one before the public understands what's happening. The next stage of this crisis won't arrive with breaking news alerts, it will arrive with inventory. As institutional portfolios unwind and households buckle under rising debt, the U.S. is heading toward a synchronized surge in supply unlike anything in modern housing history. By 2026 and 2027, entire subdivisions in states like Florida, Texas, Nevada, and Arizona, the markets with the highest investor concentration, will hit the market at the same time. And when that happens, prices won't correct. They'll collapse. Historically, every 1% rise in mortgage delinquencies triggers an average 5% drop in home prices. We're already past 2% and climbing. Analysts unaffiliated with Wall Street are projecting 35% to 70% declines in overheated markets once the foreclosure wave matures. Meanwhile, shrinking property tax revenues will strain city budgets, triggering layoffs and reduced services. This isn't a cycle, it's a chain reaction, and the timeline is already in motion. What's unfolding now isn't just a housing correction, it's the dismantling of a belief system that held America together for half a century. The idea that homeownership guaranteed stability, wealth, and middle-class security was always fragile, but today it's being exposed for what it truly was. An illusion built on cheap credit and permanent inflation. Equity is evaporating, confidence is collapsing. And millions of Americans are waking up to the brutal truth that the system was never designed to protect them, it was designed to extract from them. The housing market isn't waiting for a crash. It's already in one. Not loud, not explosive, but slow, grinding, and relentless. Every empty open house, every underwater mortgage, every forced sale is another piece of the illusion breaking off. The American dream hasn't been delayed, it's been rewritten. And what comes next won't be measured in prices, but in trust.